Hello and welcome. My name is Gino Barbaro, one of the co-founders of Jake and Gino. And on today's show, we're going to be speaking with Jay Parsons. He's a rental housing economist, investor, and advisor. Jay also serves as head of investment strategy and research at Madera Residential and has appeared on CNBC as well as Bloomberg TV and tons of other publications. Follow him on LinkedIn. His stuff on LinkedIn is phenomenal. Without further ado, Jay, welcome to the show, brother.
Hey, thank you so much for having me. Excited to be here.
You know, Jay, I love your stuff on LinkedIn. Once again, type in Jay Parsons, go follow his stuff on LinkedIn. It's thought-provoking. And what I like about it, it's objective. He just shows you the numbers. It's not how Jay feels. It's he collects all his data and he inputs it and he puts his wisdom into it. And the most recent one that I saw is one on rent control. Let's talk about this rent control cap. And you're saying there's 46 economists there in blue states, red states, and I think you said one or two would think that this rent control would be really worth it, and the rest of them say they don't. And meanwhile, we have mixed messages coming from the White House saying this is a great policy. Let's dive into that right now. What are your thoughts on that rent control policy?
Yeah, I mean, first of all, I think it's important for people to, we're such a political environment these days, a politicized environment, that sometimes I think issues get cast as, hey, this is a red issue, this is a blue issue.
Yeah.
And rent control is just not one of these issues. In fact, just kind of a way to tee this up a little bit, there's a professor of economics at Harvard, Ed Glazer, wrote one of the great papers on rent control. And he has, I heard him quoted one time, he said that he tries to avoid teaching anything political in his classes except for rent control, because that's just how damaging it can be to cities. That's the only thing, that's the only exception he makes. And so when you look at kind of the academic research around rent control, it's overwhelmingly negative. And, we could get into some of the reasons for that. The one you alluded to is a survey of 46 economists who are not industry folks. These are all folks in academia. They work for places like Harvard and Stanford and MIT, and they're all, located in blue states. But again, that doesn't matter. I think what they show is that what the survey showed is really trying to measure, hey, will the White House's proposal on rent control will have a positive impact on the middle class? And overwhelmingly, the answer was no. There was, as you alluded to, one person who thought there might be some impact, but also at the same time, admitted to some of the negatives of it as well. So, we can get more in the weeds of that if you want, but the evidence is really overwhelming. And kind of a pet peeve I have. Sometimes we see, in articles or in political conversations, it's sometimes portrayed like an issue where there's not a real conclusion or where economists disagree. And that is just absolutely not the case. Like, the evidence is really quite overwhelming from an economic research perspective on the damages of rent control. And everybody always trying to reinvent one. They'll say, hey, well, this version's different. We haven't tried this. And it's like, guys, it's just a different flavor of the same thing. You call it rent control, you call it rent stabilization, you call it good cause eviction. It's still the same thing. You're just trying to wrap it up slightly differently, but it's going to have the same negative consequences, ultimately backfire on the very people that they're intended to protect, which is why economists really don't like it.
Well, Jay Parsons has been beating the drum on one of the solutions to this affordable housing. I don't really want to call it a crisis, or there's just not enough supply, is to actually build more. Well, let's talk about that. Instead of trying to put a cap on what you currently have, let's expand it. And there's cities in Minnesota that have actually done this, and they've seen rents go down, correct?
Yeah. Again, the evidence is overwhelming, the relationship between supply and rents and just old-fashioned supply and demand. The study you alluded to is one done by the Federal Reserve Bank of Minneapolis, and they wrote a great paper showing that in areas that had added supply, there was a downward impact on rents. And we've seen that, of course, in the apartment data all across the country, where rents are the places where rents are falling. It's not due to weak demand. In fact, coincidentally, rents have fallen in this cycle in the hottest demand markets. Places like Florida and the Carolinas and Texas. And so, and not dramatically, but enough to have a real impact. I mean, you can imagine what if you had so much migration coming into these states and you were building at the levels of New York and California, you would have massive rent inflation still. So the supply story has been really important. And the last thing I want to add on this as well is sometimes when we think about, kind of solutions to affordability, what no one really gives thought to is that when you look at the peak inflation period, it wasn't just we had peak rent growth. We had 96, 97% occupancy and generally people who are paying the rent every single month. And so there's been ample demand at today's rent levels for existing product. The issue isn't that rents are too high necessarily; it's that there's not enough product, and especially at the lower price point. So we do need more affordable housing, and I'm a big proponent of public-private partnerships like the Low-Income Housing Tax Credit Program and others that really incentivize the creation of low-income housing that we desperately need.
But Jay, I never get an answer to anybody saying that, let's say we do want to rent caps at 5%, rent's going up 5%, that's fine. But what happens if my expenses tend to go higher, as you saw in this last market cycle with insurance going up? And now in your recent post, you're saying that expenses are moderating, insurance is coming down. It's a function of the market, which is the market, how it's supposed to work. But how do you combat that? Because I want to have a conversation with somebody on this rent control. And every time they do, they don't understand that rents have gone up maybe 30% over the last 3 or 4 years. But you look at everything else like gas, you look at food, you look at energy, it's gone up more than rent has. So how do we discuss that and say, well, if you're going to cap me at this price, I'm going to give you a much lower quality service product, and I may not even be able to service my debt because my expenses are going higher.
Yeah, you're right. It's a real challenge. And, one thing, all the focus on rent inflation right now that no one really talks about is when you look at who the White House and really most political focus right now is in trying to cap, it's really larger apartment complexes, not single family. It's not the mom and pop. It's not smaller multifamily like you see, like the walk-up buildings in New York and whatnot. It's larger multifamily. And when you look at price and home price inflation and rent inflation, we've actually seen much more inflation in single family home prices as well as single family rents over the last 5 years in multifamily. And so I think there's a little bit of like, hey, we want to go after this because these are big companies and that's bad. And so to your question earlier, I don't think we really think about, there's not much sympathy toward property owners. Maybe there shouldn't be, but we do need to think about it from a practical perspective, which is that as an investor, you're looking at risks. And if you see a risk of, hey, my property taxes and insurance and my payroll costs can all go, and my maintenance costs, all these things can go up more than the revenue I could recruit from it, that's a risk, and that discourages investment. And so what I would tell folks is if people see that risk in place, they're more likely to put capital in a market that doesn't have rent control or go to a different sector. They may say, hey, I'm going to get into self-storage or industrial warehousing space instead of multifamily. And so you really have to think about the trade-offs and not just kind of controlling this one little fiefdom, but thinking about the broader market and kind of where the incentives are for the investors to place capital and ultimately add supply to.
I think people forget sometimes that we're vertically integrated, so we manage our own properties. Property management and running an investment business is very difficult. It's very challenging. And I think people think that landlords are getting rich and they're getting wealthy. Well, we're putting our capital out there. Every time I do a deal, I'm actually investing my own capital. I'm taking a huge amount of risk. And then on top of that, we're trying to manage managers and maintenance techs who are running these facilities and trying to do the best job we can. I think people forget that. It's a really difficult and demanding and challenging business. And I think if people take a step back and not make it so political, how do we try to work at both ends? Because what we're trying to do is we're trying to become the Chick-fil-A of apartment owners. We're trying to deliver a really great, superior customer service. And that is challenging because you're dealing with people. They're not, units. We call them residents, homes. They're not tenants, they're residents. So when you start looking at it from that perspective, it's not just a spreadsheet. And that's where people get caught up. If you're getting into this business, you have to think of it as how you're providing a service to your investors, but also to the residents you provide. And that's, I think, sometimes is lost in translation. So I want everyone to take a step back and just think about that. These are challenging and hard jobs. And if you're a resident and you think that the landlord's evil, go out and buy a duplex, and then you rent one side to somebody else, and then you tell me how that situation goes. It's not an easy thing to do. I don't know. What are your thoughts on that?
Yeah, you're right. One of the things that's been, I think, frustrating about the whole thing is a couple points. Number one is that the vast majority, we've seen so much kind of name calling these days, bad landlords, which I don't like, tenants and lands. I don't like those terms either. And even cases that we've seen, bad tenants are being referred to as like these folks who are taking advantage of eviction moratorium and whatnot. And the reality is, to your point, is that the vast majority of renters and housing providers, I think, are trying to do the right thing.
Yes.
And I think that gets lost sometimes because of bad behavior on the fringes. And, let's be honest, like we do see reports of bad behavior among property owners or landlords. And unfortunately, those things are real, and I think they're worth addressing, but that shouldn't cloud our view of the entire market in the same way that we shouldn't see, if you have a couple people who are use leasing fraud and not paying the rent and kind of taking advantage of the slow court systems. Like, that's not indicative of most renters either. And so I think sometimes it's important to kind of take a step back and say most people are just trying to do the right thing, right? And the second thing, that I would point out is that all the focus right now on the political side of this is really around the areas where housing providers and tenant advocates disagree, which is really rent control and certain tenant protections. But where the reality is, like, there's so much commonality around the need to provide more supply and a lot of other issues as well. And so I think that what really gets lost is that, I like to tell people all the time, supply is the one thing that everybody can agree on. We can disagree on this or this or this, but everybody who's involved with housing policy agrees we need more housing. And so I wish we would do more kind of aligning on the common interests, and less on just the bickering over the areas of disagreement, because there's a lot more commonality than disagreement.
I think the billion-dollar question for me would be, how do you build affordable housing in a state or city like New York or Boston, where the building is so expensive, there's so much red tape, and like a unit of affordable housing can cost $700,000 or $800,000 per unit, and it's just not feasible to do that. I mean, I've seen some stuff go up in the Bronx where it's like they paid how much to build an affordable housing multifamily? I could have 1,000 units in Tennessee for what they built 100 units for. How do we bridge that gap? That's a challenging thing. I mean, I know you want to give tax credits and incentives, but how do we deliver more affordable stuff for the affordable space in those cities?
Yeah, well, it's a great question. Just to your point real quickly, in Los Angeles, there was an article a while back showing that it costs about $1 million per unit to build affordable, and I'll get the exact numbers wrong. That's like double the cost of building a market rate unit. So the question becomes, why is it so expensive? And the reason, what's happening right now, is that the local municipalities have enormous control over these subsidy programs that oftentimes are federally funded. And what they're doing is adding a lot of red tape and restrictions, saying, hey, you got to use these type of materials, this type of labor, you have these types of environmental reviews, and all of these things. We've talked in California, there's a big focus right now on what they call the weaponization of environmentalism, meaning like folks who really don't have the best interest of the environment at heart. They're just trying to exploit environmental laws to basically delay or prevent housing construction. And so I will tell you, again, while the White House proposal on rent control, I think was significantly off base, and other, obviously unaffiliated academics seem to think the same thing. Previous to this, going into the administration or after the election, they did have a good proposal on in boosting affordable housing as part of the infrastructure plan. And also, kind of ironically, of all places, Senator Elizabeth Warren in Massachusetts actually put up a pretty good plan recently. And really, one of the things that needs to happen here is streamlining, I think, federal subsidies for affordable housing to make sure that cities aren't allowed to essentially undermine their intent, right? Like, we should be incentivizing and really requiring cities to, hey, look, if you care about affordable housing and want to use federal subsidies to do that, you need to abide by these rules around, zoning and entitlement and building approvals, et cetera, to really expedite these things. You can't be adding requirements that actually undermine the very intent of affordable housing. And so I think there needs, and also loosening up zoning restrictions, obviously, is a big thing as well. Like, if you can't, a lot of times you say, hey, we don't have any land to do it. Well, you do. You have all these empty parking lots, and you have, crumbling lots, but you don't allow housing on these lots. And so those are things that can help too. So I think we need to see some federal tools to say, hey, we don't want to completely get away from local, governance, but we do need to have some common sense rules. Say, hey, look, if you want to use this pot of money, you need to be on the same team in terms of supporting the need for this, and not talking out of both sides of your mouth and actually making this more prohibitive.
And what's interesting is California passed that ADU, a accessory dwelling unit, which is pretty cool.
Yep.
So that is actually, tackling some form where you have a single family home and you can build an accessory dwelling on there. Hey, that's great. I mean, the land values are so expensive there that if you can put another unit, it makes sense for somebody to help them pay with their monthly nut. If they've got a big mortgage and they've got a ton of money as far as property taxes, they can shelter some of that and take some of that away from that accessory dwelling unit. We've been talking a lot of negative stuff on this show, and you've seen what's going on with the economy and all, but I know you read a lot of stuff on positivity. Where do you see the opportunities right now in the multifamily market?
Well, I think we're in such a unique period of the market right now where the demand is phenomenal, and continues to be very, very strong, but the supply is the highest levels in 50 years. And so for the first time in a long time, we're actually building enough apartments to really have a negative impact on rent. And so we're seeing rents falling in quite a few markets. And not just the top of the market, but even, we're seeing this, what economists call filtering process of people who are moving out of older Class C properties into maybe a middle Class B property because that middle Class B renter moved up to a brand new property. And so we're seeing, I think, some kind of short-term challenges. But I think what's interesting about this cycle is that because the challenges are supply-driven, they're also somewhat predictable. And what we're seeing is we know supply is dropping off significantly in terms of starts, and that points to lesser supply in the future. I tell people all the time, forecasting is hard, but supply is the easiest thing to forecast. And we know those demand drivers are generally going to be intact, barring a big shift in the economy, an unexpected recession, things like that. And so in terms of opportunities, I think what's really happening right now is you're starting to see some investors who are taking kind of a longer term lens where maybe that, we saw a couple of years ago, it was these short term flips, that really made a lot of, they were penciling out and driving a lot of the syndication activity where it was, hey, I'm going to buy an older property, I'm going to fix it up, raise the rents and sell it in a year or two. That stuff's really hard to push right now. But what is really working, the deals that we're seeing happening are these kind of longer term strategies where it's, 5, 8, 10 forever hold type situations where you're saying, hey, look, the short term, we may not see any rent growth at all. In fact, rents may even fall. But, over the following years after that, we really believe in the demand drivers around multifamily. And we think that'll more than make up for it. And even just from a basis play perspective of today's properties are oftentimes trading at values below the replacement cost. And so there's just a compelling narrative around, I think, values right now, which is why we're starting to see more activity from, certain groups.
On LinkedIn, you wrote that expenses are moderating from studies you've done with REITs. Insurance is stabilizing, thank God. AB residents are stable renters. They're doing actually very well. There's very little turnover. You said cap rates right around five caps. And from that, it sounds really positive. You wouldn't know from all the noise you're hearing. We've been hearing over the last 12, 18 months about this bridge financing, about debt coming due. Do you see a distress in multifamily taking over, or do you see lenders working with people? Do you see foreclosures looming in the horizon?
Yeah, I think it's it's a noisy market. And if you're somebody who's kind of a passive investor or an LP, and you kind of on the side and you see these headlines, and it can be confusing. And I spend a lot of my time now, talking to investors about, what's happening in the market, because I think there's sort of two different stories that are both true, but they reflect different things. So first of all, like you see a lot of stories about these foreclosures and distress, and groups that had short-term floating rate debt, and now can't cover the debt service. And that stuff's real, right? Like we saw at the peak of this, we had some groups that were buying at peak prices with short-term floating rate debt and short-term hold periods that meant they needed to sell fairly quickly. Well, then the rates went up, and all of a sudden those CapEx programs were more expensive. They probably didn't finish those things. The rents are coming down, and they couldn't refinance or sell at the exit that they had targeted. So that's a real problem for those groups. However, what a lot of people don't realize is that's actually a very small sliver. It's a noisy, loud, but small sliver of the market. That's not, just to give you some round numbers, I think that's a single digit share of the market in terms of, groups that relied on, short-term floating rate debt from a debt fund, for instance, right? Or even use CMBS, which is also a little more risky typically. That's where we see some of that distress. On the flip side, I think the best parallel thing about multifamily is that most owners are more like you think about single family owners, where they're longer term holders and they're locked into a rate, and they're generally in a better position. And even if they're refinancing, they may be held long enough where they're still in the green relative to where they would be otherwise. And so it's definitely having an impact, but the most of the market is still healthy. So we're still seeing delinquency rates for multifamily are still very low, even among bank loans. That's why I think one of kind of an overbloated story is that for the most part, actually not for the most part, but really, you look at all the different categories that banks lend on, multifamily still has one of the lowest delinquency rates, even among for banks. So, and Freddie and Fannie, which are generally more conservative type loans anyway. It's not a lot of the short term stuff, which is, Freddie and Fannie are half the market for debt. And so generally speaking, I think the market is healthy, but there are real pockets of distress that I think are creating opportunity for opportunistic buyers as well.
Where else do you see stress in other areas or niches of real estate? Would it be, office space, retail, self-storage,
Yeah.
mobile home parks? Where would you say, hey, I'm a little wary of that space?
Well, it's definitely office. I mean, you look at the, office is the one sector where there's just still a lot of uncertainty long term about the trajectory of it. And so if you're a buyer, I mean, like you've seen some of these office buildings that have sold. I mean, they're selling for pennies on the dollars because you're betting on an uncertain future. And so, one of the things that always kind of annoys me a little bit is sometimes you see kind of commercial real estate, multifamily kind of lumped into one big bucket. And
Yes.
unfortunately, I think some of the regulators have done this, even like letters they write to lenders and whatnot. You just can't do that. Like what's happening in office, and really what happened in COVID and the impact of that, kind of the office environment since COVID, is really different from what's happening in residential or retail or hospitality or industrial. And so I think, there's going to be, again, pocket of challenge everywhere, but office is its own beast. And I don't think anybody yet knows how that one's going to play out.
So what Jay is saying is, I'm not really going into office. I like the multifamily a lot better. Office is not my cup of tea right now, unless I can buy it on 10 cents of the dollar. That's what you're saying, right? And Jay, one other thing about office, back in the 60s and 70s, they built some ugly ass buildings that they don't know what they're going to do with them right now. I think it's just better to get a bulldozer and build some apartments on those office buildings. There's some really ugly ass product out there. Would you agree with that?
Yeah, no, it's funny. Like I get asked a lot about conversions, and that's kind of a big thing right now. Everybody, whether it's podcasts and media and whatnot, and even investors like, hey, what do you think about office conversions to multifamily? And it's like, okay, well, first of all, you have to really get that building for cheap. Second of all, the building floor plate has to be right. You got to have all these ducks in a row for the building structure to even be workable to residential. But then third of all, to your point, a lot of these, they're it just doesn't work. Like you'd have to have enormous subsidies, which really only work if you want to preserve a very historic building. But in most cases, it actually, unfortunately, is cheaper just to demolish the thing and start over.
Rates. Everyone was talking about rates earlier on in the year was going to go down. Then they're going to now they're going to stay stable, and it seems like the Fed is signaling that they're going to go down. What are your thoughts on rates, and how do you think that's going to impact the environment in real estate?
Well, I like to tell people that, I think there's two things that I think make economists and forecasters look foolish, and that's forecasting oil prices and forecasting rates. You just end up looking wrong. So let me just put that out there as a grain of salt first. So everything I say is a grain of salt, but because I did, like everybody else, think that rates would have already fallen by now, and I kind of think they should have, but I do think they're going to come down, and I think that signal is important for real estate investors more than anything. That hey, it's trending in the right direction. Directional, momentum, movement. Where it's heading, like that, is impactful to the market. But to what magnitude and for how long, I don't know.
It's interesting because someone once told me it's really a market cycle, but it's also an interest rate cycle. And I read something a week or two ago saying that this person's thought that Jerome Powell did not drop rates sooner was he was just trying to hold off, and he didn't want some bad deals to get rescued. He wanted the system to work itself out, where if they dropped rates too soon, all of a sudden you have some operators who are not marginal, not doing a good job. They're going to get saved by the interest rate. And they're like more like, let's work this deal through the system. Let the market take care of itself. And I think, Jay, my other point was they raised them too quickly, too soon. And I think if they cut them off a few months ago, in my opinion, once again, I think they're going to cause inflation again. I think there's so much money in the sidelines, money's going to jump in. We've got millions of dollars of equity that we can refinance out, and we're just a small mom and pop shop. I can imagine, operators who've been doing this for 30, 40 years who have bought right. There's a lot of equity that's untapped. You have a lot of investors who have money sitting on the sidelines. So if you drop rates too soon, then all of a sudden you cause a frenzy. And I don't know, what are your thoughts on that?
Yeah, no, I mean, first of all, these are really hard questions. I don't think there's an easy answer to them, but I think your concerns are legitimate, and that's obviously what the Fed's been worried about is cutting too soon and spurring another round of inflation. I do think, though, in terms of multifamily, at this point, if you look at what's trading, we're now back to 5 caps. The news on the big acquisition of the Lennar Quatera portfolio by KKR. I mean, they reported that as a low 4s cap. And so
Yes.
there are, I think, a lot of buyers today, which obviously not a ton of them out there anyway, but at these prices, but they're baking that cut already in. And they're also including a hold period that's long enough to kind of withstand, whatever fluctuations we see in the short term.
Markets. What markets are you bullish on right now? Because you've seen a lot of these markets you talked about with supplies coming in, like in Nashville,
Yep.
like a Charlotte, like in Atlanta, like a Phoenix, like a Dallas. There's a lot of supply coming in. Do you have any markets that you're bullish on right now?
Oh yeah, yeah. So, I'll tell you. I mean, first of all, I think we're at a point in the cycle where obviously, like these lower supplied markets, especially Midwest and Northeast, are outperforming. But like what they're doing is they're outperforming by simply normalizing, right? Like they don't have as much supply. It's not that they're seeing 10% growth. It's that they're in the 2, 3, 4% range, which is where they normally are. And so I think there's an argument always for, hey, those steady eddies can be attractive. But I will tell you, and so I'm always a fan of those. I think especially it's good to see some, I think, more increased spotlight on the Midwest. There's some good investment opportunities out there. But I'll tell you, like what we're doing right now in my role at Madera, and kind of where, one of my roles is trying to help find, kind of market strategies and whatnot. And we're really still bullish on these high growth markets in Texas and the Carolinas and Florida, and even Tennessee. And right now, obviously, we're seeing a lot of supply that's putting downward pressure on rents. But when you look out, I mentioned this earlier, supply is the easiest thing to forecast. These markets are gonna, in my view, I think we're at a generational high in supply that took a perfect storm of events to get there. I don't think it'll be repeated. I mean, I could always be wrong, but I don't think it'll be repeated again in any time in our careers at these levels. And when you look at kind of where starts are pointing to, I think it's not just getting to pre-COVID levels, but actually getting to levels below the norm of what we saw in the prior cycle. At the same time, look at these demand drivers, and these are still the markets people are going to. Young adults are going to, jobs are going to, relocations of corporations are going to these markets. And so these advantages for these larger Sunbelt markets are not going away, but the biggest headwind is going away. And so I think that makes a compelling opportunity to really kind of get ahead of this cycle here. And so, we're really bullish on, still places like Dallas and Charlotte and Raleigh and Nashville, et cetera, and Houston even. I think Houston's become kind of a almost under the radar market again, and it's actually building a lot less than kind of its peer market. So, yeah, there's quite a few markets that I'm excited about. I just think will take a little bit of time to play out.
Jay, you talked about on average right now, things seem like they're at 5 caps, and you're talking about primary markets. Are you concerned about any tertiary markets where people are maybe overpaying on those markets and they don't see the drivers that you're talking about? They're like, oh, you know what? I got this thing at a 6 cap. This is great, but there is risk in those markets. Can you speak to that?
Yeah, absolutely. I think what we're I obviously always want to price in that risk. And I think when we get to tertiary markets, it's really important to be thinking, and also not just tertiary markets, but also like asset quality. I mean, I think I'll get to your question, but also just kind of point out that I think in the last cycle, the folks who really got in trouble are those that are buying, C- properties at an A- cap rate. There's just so much cap rate compression that ultimately when things did change, like, yeah, you just, that this, it just wasn't sustainable. I think we're going to see kind of those spreads come back, and you look at those smaller markets. What I like small markets, but I'd be very careful about which ones you're going into. And I think what we're seeing is that these when coming out in the COVID era and the pandemic, we saw a lot of small kind of Zoom towns where everything was hot, right? But now I think what we're seeing is a little bit of the separation between markets that had some real staying power, where there's a smaller economy but it's fairly diversified. There's some good lifestyle anchors. It's still drawing people, where it's not just being a smaller city, but it's actually got a real vibe to itself. Versus let's take a spring break beach town that's a very seasonal sort of market, more of a vacation market. And I think I would just be really careful in making sure it's the type of market that has sustainable non-seasonal anchors, and isn't just kind of a very seasonal market.
I love that. Let's take a quick time out to hear from our sponsors.
Now, we have had a great run in multifamily, going from 0 units to over 250 million in assets. That's over 2,000 apartment deals that we've been able to purchase through our framework: buy right, manage right, and finance right.
Now, Jake and I, we created the Jake and Gino community back in 2015. We launched our first book, Build Our Profits. And since then, our students have closed over 60,000 units. That's over $4 billion in assets they've been able to close over the last 6 years.
And that's why this community has been so successful. We call it results-based education, and we pour back into the community everything that we've learned on our journey from 0 to 2,000 units, and all our systems and scale that we use on our very own property management and investing companies.
Jake, I love that. It's not just education, it's implementation. So what I want you to do, click on that link down below, apply to work with our team, see how we can help you on your journey in multifamily.
Now we're back, and on this part, Jay, I want to focus on the investor and on the LP. Let's talk about the LP a little bit. And I'm hearing all this noise, like you said, the fringe. I'm hearing foreclosures. I'm hearing rents going down. I'm hearing scared. What should the investor right now be focusing on, and what would you be talking to and discussing with your limited partners or your passive investors?
Yeah. Well, I would tell them at this point is to really just have realistic expectations. Like, in most cases, you don't want to be, way too optimistic or way too pessimistic. And so you're taking a clear-eyed view of the market. And so what I would tell them is like, look, do you think that the demand for rentals, is it going to go away? No, it's not going away. It's still there. Like the rent versus own analysis everybody's seen. The fact that people are waiting longer to get married and have kids, which are typically drivers to move out of an apartment, like the apartment stage of life is now lasting longer. You look at, the markets that are growing, do you think that's going to change? And so when you think about kind of those kind of, and also too, do you believe that, ultimately, real estate over the stock market over time, there's going to be dips, but over time it generally appreciates. And so do you believe in those things? And if so, and you have, I think, some flexibility in your hold period, you shouldn't, I think there's good reason to still be confident, but but I would also tell them is like, if you're expecting to just, the magic of 2021, where you can just buy something and sell it 6 months later for a 20% premium, that's not realistic either. And so I think it's just having a clear-eyed view of the market right now and realizing there's still opportunity, but it might not look the same as what you saw previously, when maybe a lot of investors got in at the peak and they thought 10% rent growth was normal and, value adds were easy. That's not normal, but there's still a compelling investment opportunity in multifamily.
You've mentioned so many mistakes that people need to avoid throughout this entire podcast. I want to highlight a couple, and then I'm going to ask you for a couple more. Number one, really not understanding what part of the market cycle you're buying in. You're buying older assets for really compressed cap rates, and you're trying to time the market. I think number two, when you're discussing not selecting the right market and understanding to being in the right market. Number three, there's just so many. And what I love about what you're talking about is the supply and demand, getting in there, understanding the supply and demand. What are the mistakes? Should they, you're talking about the bridge financing as well. People are trying to get bridge financing and trying to time the market where they've got 24 months or 36 months and they're not out. What are the mistakes should investors, especially in multifamily, try to avoid? I'm sorry, another one, operational. You need to be an operator of multifamily. You just can't go in and fix and flip. The model works until it doesn't work. And when it doesn't work, that's really painful. And we're seeing that happen right now. And that's where there's opportunity. But what other mistakes, if I want to get into multifamily right now, or I'm trying to build my portfolio, should I try to avoid?
Yeah, you're right. Let me just preface by saying, hey, look, it's always asset specific. And so there's certainly cases where I think, bridge financing can still work if you have a compelling way to do it. Value adds still work at the right prices. In fact, we're seeing some cases now where you can buy so far below replacement cost. And again, if you don't have to sell next year, you can actually pull that value add program off. And so, but again, just want to make sure there's a real story that goes with it. It's not just, hey, this worked 3 years ago, it'll work now. Like, you want to make sure you want to make sure it passes that sniff test. It's not, and especially, just fundamentally, do you believe in the real estate, right? I think that's what it has to come down to, and not just, I think we saw last couple of years, it's like, I'm in here in Dallas, everybody loves Dallas, but you see money from out of state that's flowing to maybe like the worst submarkets and buying at prices that would indicative of the best submarkets. Like, that's the type of stuff that I would be nervous about. So do you like the fundamental real estate is an important thing. And in terms of other things to kind of look for, I think also just trusting in the operator. I mean, having having a real strategy that makes sense, and not just, hey, we've done it before. I mean, track record is important, but also just having I'm a data nerd, obviously, so I'm biased here, but I think it's important to have a data driven strategy that kind of you have a reason to kind of support your investment thesis, right? And I think that's important to look for as well.
Well, since you called yourself the data nerd, let's talk about built to rent just real quick, because I think people, when I saw it come out 8-10 years ago, the shift to it, I thought it myself in the beginning. I'm like, this is insane. This is never going to work. But I guess people had gotten in at low bases for land, and they were able to really build these cheaper homes and able to rent. Where do you see the future of built to rent?
I love the build to rent market. I think it's really interesting, and I think we're only in the early innings of it. It's interesting because I think in certain markets you sort of see build to rent portrayed like it's oversupplied, and I was like, around feels like it may look that way just because it's so new, but like almost every build to rent community has been built in the last decade. Like there's just not that much out there, and I think if you look at all the build to rent construction across the country, I don't think it's even as much as the number of apartments that are being built in the top 3 apartment markets combined. Like it's just not that much. And what I like about build to rent is I think it really serves a specific niche that doesn't directly compete with apartments. I think it's more complementary to apartments, and that is, folks who are they're not ready or willing to buy a house yet for various reasons. Some are building a house, some are new to a certain city but don't know where they want to buy yet. But they also are kind of out of the life stage of living in an apartment. Maybe they have kids, they need a little more space, a little bit of a yard, they want a playground. And, let's be honest, most apartments are really built for single adults, not for families. And so the build to rent community is more like that. But at the same time, is unlike a traditional scattered site single family house, you still get the amenities and community advantages of an apartment and the on-site management, things like on-site maintenance, things like that. So I do think it's got some unique appeal. It's not for everybody, but I do think it's a sector that is going to be well positioned long term.
I've been wrong on many occasions of my life. And when I had a friend pitch it to me, literally when I moved down here in 2016, 17, I'm like, are you nuts? That's never going to work. How are you going to fund that? How is that going to make sense? How are you going to be able to build cheap enough to rent? And then 10 years later, here we're talking about it. Actually, we have a site where we can build 291 single family homes ourselves, and it makes economic sense if you buy the dirt cheap enough and if you're actually really good at construction, and then you can actually manage these things. Because once again, you need to be able to operate these single family homes. But like you said, you have the economies of scale there. It's brand new product. It's a lot easier to manage. The people who are renting these have incomes in 6 figures on average. I mean, the median income is much higher on these as well. So there's so many positives to them. It's just that at first when I heard about it, I'm like, this is not going to work. And lo and behold, I was wrong as I often am. So it's really interesting. Jay, what are you excited about right now? What's on the horizon for you? What have you been working on?
Oh man, I'm excited about a bunch of stuff. That's a great question. If you go back to like pre-COVID timeframe like that, if you think about like 2015, 2019, everything almost got, excuse me, it almost gotten a little bit boring. Like it was just kind of the same old thing every year, rinse, wash, repeat. And obviously there's been volatility, which is good and bad, but I think the dynamic nature of the market's been interesting, especially again, being a research nerd. And I think now what's compelling is that, I'm of the view that we're kind of on the precipice of another kind of a new cycle. And I think that's creating another wave of opportunities where right now there's obviously not a lot selling, not a lot starting. And that's exciting, really. I think that's where you look historically, especially like you look at like in our sector in multifamily, coming out of the great financial crisis. I remember the folks who were buying and building deals in 2010, 2011, even 2012. People call them crazy. And I still remember to this day reading an article in the American Banker, trade allocation for bankers. And there was a columnist who was openly worried about the rise in multifamily starts. And in hindsight, those numbers were minuscule. And so
Yes.
I could be wrong too, like you were about build to rent, but I think we're on the beginning of a next cycle. And one of the reasons I kind of changed roles recently is I'm excited to kind of be in the game and really help our company identify, opportunities to be successful. And one thing I'll tell you specifically is not just markets, but also I'm very interested in this middle income market. We call it workforce housing, attainable housing, or naturally occurring affordable housing even. But I, especially on the kind of the newer construction side of attainable, is very interesting. And so, just very high level, what we're seeing is that most new constructions, the high end, or it's at the low end with like the low income housing tax credit program. So it's harder, the people who live in older units are oftentimes the middle income levels. That's where that's where there's pretty good shortage of housing as well. And so I think there's a real compelling investment narrative there that's also very beneficial to renters and to communities. And so, I could get into that, rabbit hole pretty deep, but I just wanted to share that's something I'm really excited about. I think there's a real opportunity for workforce, middle income, attainable housing development and investment. And I think we're going to see, more cities and states that are incentivizing that and really making it more viable for investors to do as well. So I think that's something that is personally exciting to me.
Jay, when we got in back in 2009, 2010, multifamily wasn't sexy. And I think 2014, 15, 16, 17, it really wasn't. It was just an asset class. And then when you start with the Jobs Act and you start raising capital, and all of a sudden it becomes more opportunistic for other people to get into it, and all of a sudden capital starts flowing, you have these amazing tax benefits. That's what I think has led to this excitement that you're talking about. Every year there's something different going on, because when you have doctors and dentist groups investing in multifamily, you have all these different outsiders that weren't there 10 or 15 years ago. There was really no demand. You could buy a deal with the 10% cash on cash day one, and it was like, okay, they were all over the place. And now there's so much more demand for the asset itself. Do you see that going away? I don't see that going away long term with the tax benefits, with the asset, the appreciation, with the inflation hedge. There's so many benefits to the asset class. Do you see that going away? I think your whole idea of the new cycle is spot on. And I think it's going to be that way for the next, 10, 15, 20 years, because there's just so much money going into it. And it's a great investment. People have realized, hey, what an awesome opportunity to create wealth.
No, I agree. And in fact, it kind of reminds me, one of the questions I get a lot from investors is they look at the spreads between apartment cap rates and the 10-year treasury yields. And they say, hey, it's just compressed a whole lot. And, what's the normal? And I like to remind people, if you're going back to like that cycle when you entered, like you go back 10, 15, 20 years, those spreads were higher because apartments were generally considered a high risk alternative asset class. And a lot of things have happened over the last 15 years. Where apartments become a much more mainstream, low-risk asset class, where there's much better visibility and data now, so investors have more confidence and visibility of what's going on. We've seen much higher-end product being built. In fact, a great stat for you, most people don't realize this, this is not from Jay Parsons, this is from Harvard Joint Center for Housing Studies, the vast majority of new renter household formation over the last decade has been higher-income households, which they define as north of $75,000 in income, which has created a larger pool of investment-grade multifamily housing options in terms of the supply that's being built that's catering to that audience. And so, and also too, you think with that, like apartments, when I was growing up, apartments were generally, I heard that someone described this once, going to steal this language, kind of built with flypaper and spit and kind of B locations and just kind of, unattractive places that no one really wanted to live, but you lived there because you had to. And now you're seeing over the last 15 years, apartments built in great locations, and highly amenitized, and even not necessarily like the A+ luxury product, but even at the B levels, you're seeing really nice, well located apartments. And so all of these things I think have combined to really make a much more attractive investment class. Where you're going to see lower spreads than you saw in the past, but it's because the resiliency of the sector. I mean, look how well multifamily held up even through the COVID pandemic era. And I think that resiliency of the sector and now the increased visibility and everything else, really creates, I think, a compelling long-term investment thesis for the and also the increased liquidity as well. Like every investment type likes multifamily, so all of those things I think make it a attractive investment long-term.
And it's still cheaper to rent than it is to buy a home by several $100s on average across the United States of America. People don't understand that. And millennials and Gen Z do not want to fix screen doors, and they don't want to deal with the stuff. They're very, they can transition out to one city to the next. There's so many benefits. My last question, supply. When do you see more deals hitting the market?
Well, that's another. Just in full transparency, I've been wrong on this. Like I thought we'd see more deals hitting the market this year, and that hasn't happened. I think everybody did too. So probably, thankfully, it wasn't just me. But I still think it'll happen. Right now, a lot of what's like everybody thought there'd be more distress hitting the market this year, even if it wasn't like foreclosure distress, just the groups that were really just needing to get out of it, and even just to break even, and that. And what we've seen is that in general, like their investors and lenders have really been patient with that. It's really not wanting to have a fire sale situation. So that's been, I think, good in some ways, but also it's been discouraging to a lot of opportunistic buyers who are waiting for that stuff to hit the market. So there is some, but it's not as much. And so a lot of what's selling right now are still groups that have been kind of long-term holders. They're still in the green. Maybe wish they sold a couple of years ago, but now just need to recycle some capital and are still doing just fine. And so I think eventually, though, like we're going to have to see that. So I think I don't think it'll just the floodgates open up. But I think now that the market's sort of settling at around a 5% cap rate, there's been a little less price discovery. I think that'll incentivize more more sellers that'll start selling, and more buyers who are able to say, hey, look, like we thought we could buy it at 6, we can't, but we still like it at 5. And so I do think we're going to see that kind of gradually pick up going forward.
Jay, where can the listeners get a hold of you? Where can they learn more about you, get in contact with you, learn more about what you're doing?
Yeah, like as you mentioned earlier, and thank you for that. You can find me on LinkedIn. I'm also on X/Twitter, and you can find more about our company too at MaderaResidential.com.
And for me, as always, every time I get a chance to speak to Jay, it's an honor, it's a privilege, because Jay keeps it objective. If you want to continue the conversation, once again, go to LinkedIn, type in Jay Parsons, start reading his stuff, start commenting on his stuff, because it's phenomenal and it's data driven. He's not out there making it red, blue, black, white. He's just giving you the facts. And on occasion, he may be wrong, like I was wrong. But over the long term, I think a lot of his analysis is going to help you out to become a more objective real estate investor, because there's a lot of noise out there. And what Jay does really best at, what I love when I read his posts and I really engage with him, he just keeps it down the fairway. He just gives you what's going on, and then he gives you his honest opinion and assessment. He's been doing it for decades. He's got a ton of experience, and I just want to thank him once again for being on the show, and good luck on this new opportunity you have, Jay. Thanks for being on. I appreciate it, brother.
Great. Thanks for having me. I appreciate it.